So the uncertainty around jobs is actually going to be the key driver of what we estimated in March was going to be a more elevated volatility environment. You know, at the time we'd had a long period of volatility in the VIX in the low teens, and that was sort of justified by the economic environment. But for the outlook we're expecting, if you look at regimes back to the 1960s of declining nominal GDP growth, rate cuts, but then jobs uncertainty, you tend to get more like 20% volatility environments. So we've been expecting a bit more volatility and for volatility to be more volatile. So actually the last couple of weeks have been kind of just what we thought, except the spike we got was a huge overreaction. And there are consequences for that in the market. But equally, the retracement now appears to be a bit of an overreaction, because until we're sure that this slowdown does not cost jobs in the US, we should expect that uncertainty to produce this moderately elevated level of volatility in contrast to what we've seen. If it does produce job losses, then it's more of a hard landing, in which case the volatility may well end up being higher. So it's going to take us a few months to work out whether it was hurricane related, whether the consumer really is slowing. If we've got a 20 volatility environment instead of a 10 volatility environment, we should see lots of rotation in the market. That's what our traders are reporting, lots of movement.
That makes the next NFP absolutely crucial then, doesn't it?
Yeah, well, it makes the NFP reasonably crucial, but we get weekly data points on the initial jobless claims as well, and those have been sort of slowly ticking higher, but each week we get, like this last week we got some reassurance that it's not accelerating. So, but yes, I think the jobs data point will be all jobs data points will be the key data points for the next few months, while we determine whether what is fairly clearly now a slowdown is a mid-cycle slowdown that rate cuts will eventually support, or whether the mid-cycle slowdown is actually something a bit worse and cascades with job losses into a deeper slowdown or recession.
So tactically, what is the right strategy? Because market participants have been using this trade in the last couple of weeks as a way to get into things they like for the long term, to rotate out other things. What's, in your view, the right tactical trade here?
Well, it's really interesting because it completely depends on your time frame. I mean, when the VIX jumped to 60-odd intraday, it wasn't at all supported by credit spreads rising. They rose a little bit. So it really told you this is a very short-term technical thing, which, you know, being in a bank, actually, you see a lot of these flows, and we could tell that a lot of it was more quantitative, data-driven short-term flows. So risk targeting funds, CTAs, all just selling in a fairly illiquid August environment. So the overreaction on the downside was too much, but then equally, if volatility retraces very quickly, then all of the causes for the selling reverse into causes for buying. And so that's really what we've seen so far. So our view is, so long as we do end up being right on the volatility environment, that we do settle at a slightly higher volatility level than we've got at the moment, you know, VIX goes from 14 back to 20, then we're probably in a bit of a range in markets. It might be a range that's got a slight upward tilt or a slight downward tilt, maybe it's sideways, but it's not the strong markets we've had. And so in that range, what investors should prefer, and historically works when your starting point of volatility is higher, are quality stocks. And that's different to what we've seen for the last 6 months with cyclicals continuing to outperform. I think the cyclical outperformance may be a bit at risk if volatility persists and rises a bit from where we are today.